Hello, this is Richard C. Wilson at the Family Office Club, and today we're doing a member spotlight interview with Daniel Cohen from Cohen Company. Welcome, Daniel.
Thank you, Richard. It's great to be here.
So what does your investment firm focus on doing every day?
Yeah, we focus on investing in banks and insurance companies and other vehicles that have low volatility. And then feel strongly we have great advantages for investing in them. So we've been doing that in the form of subordinated debt over the last 20 years. And really in the CLO market, we've been there since 2005 as a manager, as an investor, as an opportunistic participant in the marketplace.
Okay. I think most family offices, even sophisticated ones, might not be familiar with the scope or the breadth of opportunity of investing in insurance companies or insurance offerings. Can you talk about just the size of that market or some high-level details?
It's a very large market. Surprisingly enough, there are in Europe and the United States over 8,000 small insurance companies that need funding and that bear risk for a variety of different things that they do. The number of them that fail and their debt failures each year are very small, but accessing them as an investing class, while they're willing usually to pay relatively high rates for capital that they need, simply accessing them is a very difficult thing. So we've amassed the assets that we have under management basically by lending to these insurance companies in long-term debt that's very stable.
Okay, great. Yeah, I've just become much more familiar with it recently as we onboarded a investor client, and they run an insurance company, and they're looking for those very secure type investments, and probably a connection for your firm actually. So also, I think the retail investor world learned about CLOs during like the 2008 kind of meltdown, and they found out these things existed and said, oh my gosh, this caused a lot of problems in the financial system. But they've been around for a long time, and there's all different types of CLOs out there. Can you talk for a minute about that market, what a CLO is, and just kind of clear any confusion there might be about that space?
Yeah, what a CLO really is a bunch of loans all packaged together, typically about 300 loans that are to all sorts of companies and specifically in lots of different sectors. So not concentrated in one particular sector. As a group, these loans have outperformed almost anything. Even those that were done in the financial crisis wound up having positive returns on average to their investors. And in fact, the structures only get better. Gives you an opportunity. It's like a bank, but one where other banks really provide the most senior funding instead of the depositors. So the opportunity that you have to invest in such a vehicle can be very good, but you have to be opportunistic and knowledgeable, I believe, on how the market really works, and also, see the opportunities that are there, that are given there at various times. We've been involved in that, like banks and insurance companies, for over 15 years now, and we've really developed a core expertise in the CLO marketplace. We've invested our own money constantly in this, looked for good opportunities for other investors, and have gotten excellent returns over the years.
Sure. I know one of my mentors, a decade ago, was kind of grooming me, and he told me some of the smartest people in finance work on the debt side of the balance sheet, because of the downside protection. And I know you've grown to over $2 billion in assets, if I'm not mistaken, correct? What's kind of your ballpark AUM now?
$2.5 billion under management.
Yeah, congratulations. So what is key to your value add process that has allowed you to get there while there's so many mom and pop investment firms out there that are 30 million in assets, 150 million in assets, and here you are with 2.5 billion in assets? What's that value add process, or what's part of that sauce that's gotten you there?
Well, I think that it's really focusing on stable asset classes that have a lot of longevity. So I think banks and insurance companies, banking and insurance has changed over the last 20 years, but the need for banking and insurance continues to be extremely high. Insured deposits from the FDIC, and you need to insure your house and everything else that you have, even today's cyber insurance. There's lots of niches that are serviceable by the underlying sectors. So in the context of a very secure, highly regulated environment, we've dug deep and done this for a long term and keep getting better at what we do. And, you know, our only real constraint is the amount of lending that we can do in the firms that we like, because we would like to have not just the low rates of loss of everybody else, but even a better performance. So I would say we built an organization with longevity of employees, with great people that actually have been doing and focusing on this sector for a very long time. And that's our singular approach to everything that we do.
Okay. I think SPACs are really interesting. I know some SPACs raise capital, can't find a good enough deal. From what I know, all SPACs are publicly traded. Maybe there's a type, you know, you're in the space, maybe there's SPACs that are not. But can you talk a little bit about your work in that space, how you know which ones are going to perform well or not? I'm guessing you choose ones that are obviously focused on debt or CLOs or your niche area of expertise, but I'd just be curious to learn a little bit more about that.
Well, actually, we started off in the business because we saw a huge change in financial services that really led us to launch FinTech Acquisition Corp, which was a very successful SPAC, which bought a company that then was sold to First Data. We then did other SPACs after that. And building on this, we decided that there was a proposition that was very strong, which was the nice thing about SPACs are that an initial investor in the SPAC can get 100% of their money back plus interest within 24 months. And that's happened whenever a SPAC hasn't actually been successful. It seems like it would be impossible to take a company public through a SPAC, but even recently, the performance of companies like DraftKings and Virgin Galactic and Nikola Motors have been spectacular because it's a great vehicle for a variety of reasons, which we know. I'll just keep it short and say, which we know the dynamics of all the various transactions, the ability of a sponsor to identify deals, the ability of companies to do well over time. But our downside is that we get 100% of our money back if there's anything that we don't think is a great winner. And it's a marketplace that we know all of the players and we know all of the companies. And like many of our marketplaces, relative to something huge, we don't want to try to master the stock market or master the entire bond market. Our marketplaces are $50 or $100 billion of assets, niches that are susceptible for us getting an information advantage and getting a knowledge advantage. And SPACs are at their highest point and well known now because of the companies that have gone public through them and their longevity now in the financial system. But, I think there's only $22 billion of SPACs outstanding. So it's a big asset class, $22, but it's a Goldilocks asset class, not too big, not too small. So.
Right. Okay. Great. That's helpful. What's the number one due diligence question that investors should be asking a firm like yours, whether or not they ever ask you? Like if you sold everything, had an exit, got bored on the beach after a while, went back into investing with someone else who would be one of your peers, what's a really smart due diligence question they should be asking or you would be asking?
I think that a great question would be, whether the manager really understands what the investor is trying to achieve in the portfolio and why they want to invest in this, because that's a key element to what you invest in. What we do is we're looking to produce both current income and stability of value for long periods of time, and that's what we're able to do. We're not trying to invest in something that might have a 50% return for a short period of time, and we're not looking to invest in something that is very, low return or even a very high return for long periods of time, potentially with a high risk. So we're sort of, I think it depends on which managers, which products you want to invest in, depend really on, what your goals actually are. So making sure your managers are aligned with your goals, I think is a key element to investing, and a good question for your managers.
Right. Great. And then the last question is, what's a $100,000 piece of advice that you could give investors listening here? Maybe something that you wish you knew 20 years ago.
Something I wished I knew 20 years ago. Over the last 20 years, as I said to you before this audience, I've been surprised while I've been at the same job, quote unquote, how the world has really changed after time. And that the reality is that attractive investment opportunities do change. And while you can't be attracted to the latest flavor, just to switch into what seems to be the hottest class, on the other hand, there often become available situations where you can make money over long periods of time. That, some of them may be 30 years, some of them may be 40 years, some of them may be 5 to 10 years. So, understanding the changing investment opportunity set is key, and having an investor that's had that experience and won't be surprised by something, is also, I think, a key thing. So I'd say the best advice would be to look carefully at the opportunities and invest at those that you think will be good opportunities, not just because they're hot, but also because the investments that allows good returns over a medium period of time.
Right. Okay, great. And what's the best way for someone to get in touch with you to learn more about your firm?
Well, usually I'd say give me a call on my cell phone, but this is more general than that. I think that the best way it would be simply to go to our webpage where we have contact information, and we're happy to respond to any contacts that we really have.
Okay, and what's the website URL that they should go to?
It's www.cohenandcompany.com.
Great. So that's a Cohen, if anyone's listening.
Yes.
Right. Okay. Great. Well, thanks for your time here today, Daniel, and appreciate your help, and hopefully have you on a virtual investor discussion panel again soon.
I'll be excited to be on it. Thank you very much.
Yes. Take care.